My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make you some money. My job is not just to entertain, but to educate and teach you, so call me. 1-800-743-CNBC. Or tweet me at Jim Cramer. Can you imagine what would happen on Monday if we got a trade deal over the weekend? After an incredible session where the Dow surged 223 points, hey, breaking through the key 28,000 level.
That was easy.
While the S&P gained 0.77%. Sixth straight up week. Bye. And the Nasdaq set a new record, rising 0.73%.
House of pleasure.
On positive trade chatter, I have to tell you, I think it is within reach. We need to approach this stuff with a certain amount of skepticism. But it's a real possibility. All that needs to happen, frankly, as I've spent my whole day on this, is that the Chinese need to pay market prices for boatloads of pork, and we could get an agreement that opens up their markets to our financial companies. A pork deal wouldn't even be much of a favor. You know the Chinese need pork because their pigs have been dropping like flies thanks to that swine flu, Asian swine flu. No one's been able to solve it yet. But that's the sticking point. See, President Trump knows the Chinese actually want and need our pork. Yet they keep trying to bargain with them. I mean, come on. At this point, I honestly don't think that they're that far apart, at least not according to the president's chief economic advisor, Larry Kudlow. However, if China doesn't give in and order some bacon, it could be curtains for these trade talks. If the negotiations fail, that ushers in the next round of tariff hikes, which would, of course, go into effect in December and might crimp this beautiful 6-week rally. Without a deal by Monday, I bet we'll actually see some major profit taking in a host of sectors, led by healthcare. Now, this group, especially the managed care stocks, went completely bonkers today after they got two fabulous pieces of news. Not one, but two. First, the president unveiled a new transparency program so everyone can know the actual cost of their health care. And it was a lot less intrusive than investors had expected. Then second, Senator Elizabeth Warren, the Democratic frontrunner, said she would not try to implement single payer until the third year of her presidency. Well, hey, Wall Street's been terrified that she wants to abolish private health insurance. Talk about just wiping out a whole sector. But today we got reason to believe that she might be more open to compromise, or at least to kicking the can down the road. No wonder the managed care cohort absolutely caught fire. And given Warren's statements and how underinvested portfolio managers are in this group, it may not be done. My charitable trust, you can follow along at ActionAlertsPlus.com. We trim some because we're not greedy. Still, I mean, and also because I do have some doubts that the Democrats will keep vacillating on health care as the primary goes on. And the next time Warren says something harsh about this group, well, it's going to give up some of its gains. So we're just trying to be chary. Of course, worrying about this stuff is probably pointless. None of these pie-in-the-sky programs even going to pass Congress in 2020, even if it's a wave year for the Democrats. But we know from experience that Wall Street will take any excuse to freak out about the managed care stocks. That's why they've been so horrible. Anyway, so I expect a little profit take on Monday. What about the rest of the week? Tuesday, we get results from three big retailers: Home Depot, Kohl's, and TJX. I expect Home Depot will have tons of good things to say thanks to this pickup in housing. By the way, the stock tends to open up and then go down really hard. I've followed this pattern for, I don't know, when Bernie Marcus was running the darn thing. However, the despot does tend to then rally over time, so you can buy the weakness. If you don't own it yet, though, after what I just told you, I think you'll wait for the quarter. TJX is worshipped on Wall Street. I shop there, and not here. This is a Brioni, but I like to shop at TJ. I got a belt there recently and a nice pair of slacks. And I have to tell you, whatever they say goes. They could say, listen, we're going to burn all our stores down. People love these things so much. So TJX, it works. Kohl's, I'm calling it a conundrum. The last quarter, horrendous. Can this company really turn itself around in 90 days? Call me skeptical, but they do that tie-in with Amazon. They got those big brands. I like the stores. They're nice and clean. That may not be enough. Next week, we're going out to San Francisco, in part to cover Dreamforce, Salesforce's cloud computing extravaganza. These trips are always incredibly educational. The companies I speak to out there have so much to tell us. That's where all the action is. I mean, I can sit here and just talk about Goldman Sachs until my head's blue, like the Blue Man Group who retweeted me today. But I can tell you that the place to get all the information is here. And that's exactly where we are going. I don't like to sleep next week, so I don't. Anyway, on Wednesday, we hear from two of my faves for the holiday season, Target and Lowe's. Now, Target's become a terrific turnaround story. Have you been there lately? Have you been to the inner city ones? How about the small format ones? Have you checked those out? I mean, they're unbelievable. And the leadership of CEO Brian Cornell is fantastic. Lowe's, a bit of a work in progress. Where did I get that from? Marvin Ellison, the man at the helm. He tells me it's a work in progress. I believe in the work, and I think he's doing a great job. The stores are you should go to stores. Try to go one that you haven't been to in a long time. It is so much more clean, and the people are much more helpful. After the close, Medtronic reports. Now, we've liked this medical device maker ever since we met with its CEO at the J.P. Morgan Healthcare Conference earlier this year, retiring. Medtronic may not jive with the stronger economy that I've been talking about, but the company's a standout performer, and the device stocks are red hot. Remember Dexcom the other day? Thursday, we get results from Macy's. So many people are betting against this chain because it's developed a habit, a nasty habit, by the way, of missing the numbers. I think that negativity means it might actually be a decent trade going into the quarter. Or to put it another way, can Macy's really be as bad as the stock seems to be suggesting? I don't think so. Hey, the Bloomingdale still looks good. There's nice stuff there. I get some stuff from my wife there, apropos of absolutely nothing. Anyway, if you buy Macy's for trade, don't overstay your welcome, though. By contrast, Ross Stores reports after the close, and this is another one of those worshipped stocks. The discounter almost always reports a decent number. Then the stock gets hit, usually for about $2 to $3, and then you buy it because 10 days later, it's dramatically higher. That's just how it trades. I've been trading it forever. And then I once, they have really cheap belts and umbrellas. Then there's Splunk, the cloud-based software analytics play. Earlier this week, the stock was hammered by a boutique research outfit that argued the shares might be overvalued. I think Splunk's fantastic, although I recognize the space has gotten a little crowded, including a tough competitor that we're going to introduce to you tonight that I think you might like more than Splunk. That's a hint. That said, well, I'm siding with the bulls when it comes to Splunk. Now, let's talk about one more that is really problematic versus the old days when it was just red hot, but that was the days before the web. Nordstrom. This is another department store that's generally perceived as being completely off its game. Their new store in New York City, I went there this week, it's Marvel. But it's also a symbol of everything investors have rebelled against. A big brick-and-mortar institution with high prices, no real place to park. Hard pass. Oh, and remember to the bulls out there, please be careful on Thursday. You know what happens? This Loretta Mester, she's the president of the Cleveland Fed. She's going to be speaking, and she is a one-woman bull market wrecking crew. She's amazing. I mean, a little over a year ago, this woman talked about an accelerating economy right when we were about to crash, said the Fed needed to tighten aggressively right when they needed to loosen aggressively. It was an appalling performance that contributed to the market's horrendous fourth quarter meltdown. I wouldn't be surprised if she does the exact same thing around this time. What can I say? She's a downer. Friday, we take the pulse of the food stocks with J.M. Smucker in a group that's been all over the place. Smucker's really been bad. They got these categories, pet food and coffee that are a little too competitive. I think the stock can bottom, though, at a certain level. I'm certainly waiting. And then get this. Foot Locker reports, and this one's too difficult for me to game. If I like sports, I'll go get Nikes. I'll go get Under Armour's. More on that later. Of course, these days we scrutinize everything through the prism of the trade war. I think Foot Locker's numbers could give us some insight into how the consumer's handling the tariffs. So far, so good. The bottom line, after still one more bullish week, and that's not deniable. That's not fake news or interesting. It's not it's just true. This market needs a win in these negotiations with China. Bring home the bacon. If we don't get something positive, I think the whole edifice will start to crack. Unfortunately, at this point, it's really up to the Chinese. But that might make these big pork purchases and keep cracking down on fentanyl smugglers. And guess what? I think that will do the trick. Ralph in New York. Ralph.
Yeah, booyah, Jim. Thanks for helping people like myself. I got limited experience, and I need some help in this game.
Well, I can help. I'm here to help.
Okay, look. Back in July, I bought a small position in Hasbro.
Okay.
And I paid just under $122 for it. Ouch.
Ouch!
I'm down about 21, 22% now. Now, I know it's tariff sensitive, but what do you see about Hasbro?
Well, they just did a big equity offering to pay down for a deal they made. They had all sorts of things go wrong, especially, of course, Toys R Us. Not unlike, I think, Under Armour had some bad luck with Sports Authority. I think at 95, you're fine. I just don't think that I don't want to necessarily average down here, in part because they just did this big equity offering and the stock's trading very heavily. All right, we need something positive on China. We really do. Or else the edifice could do some cracking. All right, Mad Money tonight. It helps over 18,000 brands, including Delta, HSBC, Home Depot, communicate with their customers, and it's up 100% so far this year. Okay, is it time to consider live person? I've got the CEO. Then, with better than expected retail sales this morning, wondering what the heck is happening in the space? I'm giving you my take, and I'm eyeing the Henry Schein spinoff Covetrus to see if the stock at last could be part of the humanization of pets in a way that is not destructive. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.